Financial Strategies. Welcome to our presentation today on investing for your bracket. If you're able to listen to this live, I encourage any questions as you want to maybe pop those in the chat. If you're watching this as a replay, please feel free to reach out if you have any questions or concerns, or just want to chat over the material with you. We're going to get going through this today. I'm excited to be chatting with you about this on March 25th as tomorrow we find out if Iowa can actually beat Nebraska this season and move to the Elite Eight, which hasn't happened since I was a kid. So pretty excited about that. Let's get jumping in. We're going to talk about how investing for your bracket might be something for you to consider. Before we get too far in the discussion, I need to admit that I was not a great basketball player. As much as I love the sport, I was not a natural. But there's a lot that we can apply to the world of sports in general, to the principles of investing, and we're going to explore that together today. When you think about investing, it can feel really complex, and particularly in the kind of environment that we're in right now, where there's a lot of volatility and there's a lot of noise in the market, it can feel a little extra complicated. Whether you're building wealth, you're planning for retirement, you have a goal in the future, just trying to make smart decisions with your money, starting with a solid foundation in the market basics is going to help you stay on track. So navigating those kind of ups and downs like we're experiencing right now, to informed choices, knowing how the market works, it's all going to help work together to help explore how we'll use those to help us meet long-term goals. We're going to talk fundamentals of the game today, so you can invest with greater confidence and peace of mind. And then we're going to talk about kind of the final four. So if there's anything to kind of take away from this in terms of how you approach investments going forward, it's going to be in that final four. So let's start with the basics, dribbling and passing, the investing basics. Let's understand how those basic terms and concepts can help tie this together for you. All right, so when we think about the kinds of investments that we're going to be participating in, there's really a couple kinds that we'll see most commonly. We'll hear people talk all the time about stocks. What that is, right? Stock is just shares of ownership in a company. There's a potential for higher return potential, but a higher risk potential. Bonds are essentially loans to governments or corporations. They have lower risk, lower return potential, usually have some kind of a fixed interest payment. Commodities, those are going to be investments in things for physical goods. We think a lot of commodities like gold, for example, but especially in the market right now, we're hearing every day about oil. Oil is an example of a commodity there. So mutual funds are professionally managed pools of money, and this is going to be, they can be all stocks in mutual funds. They can be all bonds in mutual funds. They can be combinations of stocks and bonds. They can be combinations of stocks, bonds, and commodities. So as you get into the mutual fund, you want to research a little bit about what that manager's goals are and what kinds of things they're going to be holding under the hood of that. Similarly, exchange traded funds or ETFs, they work a lot like mutual funds. They're traded like stocks, but again, they can be all stocks, all bonds, commodities, combinations of any of those things. But once you kind of have that basic, you'll start to see how these are going to work together, what the risks of stocks are versus bonds. We'll talk more later about diversification and then understanding the impact of time horizon. But before we get too much further into talking through how we put the pieces of that together, I want to make sure that we talk about the time value of money. Hey, good morning. Just want to let you know we are recording. If you have questions as we go through this, go ahead and pop them into the chat. We just got started talking a little bit about those investment basics. I'll back us up just a second here. We talked high level about what our goals are going to be for today. Our goals are going to be talking through investment basics, market fundamentals, kind of the final four takeaway from this. So as a recap, we talked through stocks. Stocks are shares of ownership in a company, higher risk, higher return. Bonds are going to be loans, things that we're loaning or giving our money as a loan to a government or a corporation. They tend to have lower risk, lower return potential with fixed interest payments. Commodities, these are going to be actual physical goods. This has been the news a ton recently as we've talked about oil prices and how oil kind of fits into those kinds of investment alternatives. Um, Commodities can be very, very risky. They can be, up really high, down really low. Kind of depends on a lot of the things that are going on in the global market overall. So, for example, oil is a great example of that. It can be very volatile investment. When we think about mutual funds are just professionally managed pools of stocks or bonds or commodities, combinations of those. So a mutual fund can have all stocks in it, it can have all bonds in it, it can have a combination of both stocks and bonds, have some commodities in there as well. So when you're looking at a mutual fund, it's important to know what exactly the goal of that manager is, so you know what you're getting there. ETFs or exchange traded funds, very similar to mutual funds. They're going to have a combination of stocks, bonds, commodities. They can be, again, all stock, all bonds, all commodities. Before you get invested, you want to know what the goal of that investment manager is. That brings us to what we were hitting on, the time value of money. So when we think about the time value of money, it's a pretty basic financial concept that talks about the value of a dollar today versus the value of a dollar in the future. When we think about time value of money, the concept really centers around the present value and the future value. So as an example of this, if I think let's say I have $100 to invest today and I can get a 5% annual return, the value today is $100. The future value would be $105, right? So my premium is $5. Why does that matter? Well, the concept of the time value of money and those calculations help us determine how much we need to save to reach a financial goal, or to help us calculate the amount of future value an investment might have for us, or the cost of things like loans. If I take out a loan for my 401k plan, what's the real cost of that? Not just for me today, but what's the cost of that missed investment opportunity in the future? So understanding that helps us figure out how much we need to save per month, helps us figure out how long we need to invest for, and it helps us also determine how much risk we can take, right? So let's say I need money for a down payment on a car and I need that in 2 years. Well, I probably don't have a lot of time for that to garner a ton of return for me. I also don't have a lot of appetite for risk. So I probably want to be a little bit more conservative given that time frame. Whereas retirement, we tend to think of that as like a longer term goal, right? So if I'm investing for 10 years down the road, well, that 10-year down the road, if I have that invested, I have a lot more potential for that to grow for me. So I have more appetite for risk. So understanding how the time value of money plays into this will help you figure out how much you need to be saving, how much relative risk you'll be able to take as you get invested. So we're going to talk a little bit about behavioral finance. I have to laugh a little bit at this because when I think about behavioral finance, I think of, whenever I'm watching a game, that's a basketball game or a football game or whatever it is, I end up usually screaming at the TV because you end up looking at it going like, why don't you see this? Why don't you see that there's somebody set up over here? What are they missing? They're not seeing everything. Well, when you yelling at the TV like that, what you're ultimately talking about is akin to behavioral finance, because when you're in the thick of it, when you're in the game, you're unlikely to see the whole floor and all of the moving parts. Whereas if I was standing more objectively away from that, I'm able to see things that the person on the court can't see. I might be able to make a better decision. So what happens a lot of times when we talk about behavioral finance and investments, people can become apt to making flawed decisions because they aren't seeing the whole picture. So we look at behavioral finance as kind of a measure to help us identify how to make financial decisions in view of larger market trends, and understanding how things like volatility, human behavior might impact the decisions that we're making, because errors in thinking can often lead to flawed decisions. Probably the best example I can think of this, and we'll talk about this here just in a second. When the market is really, really volatile, the tendency a lot of people will be to pull their money out. I want to take that money out of the market. Well, the problem is that we can't predict with very much regularity when we're going to see a market return. When all of a sudden the market pops and goes up, if we're not invested, then we're going to miss that. If we're missing that rebound day, can have a profound impact on us long term. Being able to stay the course is really, really important to investing. You want to avoid things like excessive trading volume, getting in or out of different investments. You want to resist the urge to take your money out or stop contributing when things get volatile. You want to make sure that you have a game plan that you can really sit with, that you feel good about as you get going into your investing journey. Which kind of leads me to, knowing what quarter you're in, right? This is going to help us identify how much risk we can take, right? If I'm in the first quarter, I can take some more risks. As I get closer to the end of that game, right, I still might need to take a few long shots there. Again, I'm an Iowa fan. That was so exciting to see the end of that game. And when Fulgaris took that 3-point shot with 5 seconds and hit it, like that was a pretty big risk, but at the same time, he was well set up for it. And they'd been fighting that whole quarter, or to keep things in line. When we think about investing, I want you to think of it a little bit in the same terms, knowing what quarter we're in, making sure we're investing for the long term. Market ups and downs are going to be pretty normal. Volatility, pretty normal. The hard part is in the moment is controlling your emotions during that. If you've ever taken a look at this, on average, stocks will see a correction of 5 to 10% about once a year. Many of them coming in positive years. That happened to us in 2022. That happened to us in 2020. That happened to us in 2023. In fact, I think when they look at the historical data at the S&P 500, we've had at least one 10% correction in 62% of years since 1928. So even though we're seeing a lot of volatility right now, and there's absolutely a correction, a part of that correction that seems to have been taking place, that doesn't necessarily mean that this is a bad time to be invested. Knowing that corrections are normal, that they come every year, probably doesn't make you feel a whole lot better in the moment. But if we consider the S&P has averaged about a 13% return since 1980, despite all of that volatility, I think the message becomes a little bit more clear. You want to be patient, stay invested, and don't panic. So before we get into kind of this next section, we're going to talk about market fundamentals and some other things, some other tips when we think about investing that we have not talked about, concepts we have not talked about before. Before we get into that, I want to just make sure that we cover some kind of tips for beginner investors. If that's you, if you've never done this before, or if you're pretty far along in your journey, what are things we know we want to do? We want to start early, making sure that we're contributing into something like our 401k plan regularly. Doing it as soon as we can for as long as we can makes a huge difference. We want to define our goals. What are we saving for? What are our objectives? Is it retirement? Is it buying a house? Is it just growing your wealth? Is it buying a car? Those goals are going to help us identify what our time frame is, so we can identify what our time value of money is, what kind of risk we can take. It's really important to know what we're saving for. We want to learn the game. So we're going to talk about this a little bit more. Making sure that we understand the kinds of investments that we have available to us, what kinds of investments might be appropriate for us or not appropriate for us. We want to be consistent in that game, right? So once we know what our game plan is, we want to stick to that. So if we started early, we want to stick to that. If we have our goals defined, we want to stick to those, making sure that we're being consistent time over time. And last is just consider coaching. If you've never done any of this before and you just want to talk about your investments, what options might be appropriate for you, absolutely reach out. Give us a call. This is what we're here to help you do. So don't ever feel like you can't reach out and get answers that you might need for your situation. All right, so now we're going to switch games here and talk a little bit about the fundamentals of the game. We're going to need to take a look at things like what's happening in the market, how the market shapes, how the market itself kind of shapes the landscape. Just to come back to basketball for a minute, if you've been a long time basketball fan, you know how much the game has changed. So, I mean, full disclosure, I'm uh, in my late 40s. My favorite era was, Michael Jordan Bull era basketball. It's my favorite time for basketball. The game has changed a ton. Back then, we just did not see people shooting three-pointers every single game, 10, 12, 13, 15, 20 times. We really didn't see the shot used that much. And I think it was like 1980 before the three-point shot was even something that was a part of the game. So when we think about this, again, bringing it back to investments, you need to understand how the rules of the game might be changing over time, kind of what the backdrop of that is, for you to identify what might be most appropriate for you. You need to understand some concepts, the market conditions, which change super quickly, so that when you're thinking about the kinds of investments you're taking, you know kind of what the rules are for the game that you're playing. So we're going to start by talking about the stock market itself. So again, when we think about stock exchanges, it's kind of the major exchange to provide a platform for trading stocks. We think about those. What can be difficult as we think about, like, if I'm invested in my 401k plan, I probably just have mutual funds or ETFs in there. ETFs are going to trade very similar to stocks. Mutual funds trade a little differently. Stock exchanges, things like the New York Stock Exchange, those kinds of things have a platform where you can trade stocks really as long as the market is open. ETFs are going to be the same way. Mutual funds, however, only trade one time per day. So where a stock or ETF trade what we call intraday, so their stock price literally changes at all points in time throughout the whole day. A mutual fund, its stock price becomes fixed at 3 p.m. Eastern Standard Time. So if the market is open, the mutual fund itself will lock in its price at 3 p.m. Eastern, or 3 p.m. Central, sorry. The second thing is understanding primary versus secondary markets. So companies issue shares through a primary market. We call those initial public offerings, or IPOs. Those are going to be done in the primary market, but afterwards it's going to switch and you're going to trade them to on a secondary market. Investor participation. So there are different kinds of people who are participating in the markets that we're talking about. You have traders. So thinking about, like, if I work for a big bank, right, I might be buying and selling literally thousands and thousands of shares of a stock in a single day. An investor might be just selling, a personal individual investor might just be buying a few shares within that day. The amount of movement that you get when you're talking about that price movement that happens intraday will be dependent on that investor participation. So if all of a sudden I start to see that everybody's buying Nike, that's going to push the price of Nike's stock up. If I see, for example, everybody's selling Microsoft shares, that might push the price of Microsoft down. So that kind of participation can absolutely impact the price changes. But generally speaking, when we're buying or selling those stocks, we get our profit from the price movements intraday, and we can earn dividends on the number of shares that we sell as dividends are declared. This happens in mutual funds as well as stocks and ETFs. So if I hold a mutual fund today, believe it or not, stocks that the mutual fund itself owns, those receive dividends, and those dividends are paid back, generally reinvested into the mutual fund. Lastly, our market indicators, the broad market indices that we use to kind of help us identify how the market's doing overall. We usually use the S&P 500, which is Standard & Poor's 500, it's the largest 500 companies in the United States. Dow Jones, which is about 30 stocks, most of which are actually in the S&P 500 as well. Both of these are ones that we use very often to help us judge how the market itself is doing, how the overall market is doing. So when you hear people say, oh, the market is up, usually they're talking about the indices itself and not necessarily a particular stock. So you can have situations where the market is up. Hey, people are saying, oh, the market's up, but the stock that you hold went down, right? because what they're talking about is that the broader market indicator and not the stock that you own itself. So understanding kind of how your stocks that you might own or the mutual funds that you're participating in might be moving relative to that indices can help you kind of gauge a little bit about what people are talking about with respect to them. The other part I talked about a little was price determination. You know, the price of a stock throughout the day are going to go up and down throughout the day. And you're going to have two things that are happening within that. They're going to be market prices are going to be set by buyers and sellers who are negotiating a price. You're going to have a bid price, what people are willing to pay, and an ask price, what people are willing to sell it for. Generally speaking, they're usually pretty close, right? So let's use a sample example here. Let's say I'm buying Nike stock. Well, if I'm buying Nike stock and the ask price is $100 a share, I'm probably not going to put a bid price or have a bid price accepted that's $50 a share. Usually they're pretty close. What you can see though is the market kind of moves throughout the day. As you can see, if people are not getting their ask prices fulfilled, then they'll start to drop those ask prices. That means that the value of the stock is dropping during that day. On the flip side of that, you can see stock prices increase if people feel really optimistic about the company's future. So maybe they're going to be they're doubling up at that ask price way more than the seller thought that they were going to get. Well, then that seller is probably going to increase their ask price, and as that goes up, then you're going to get a bigger return off that investment. The other time you might see that is if you have maybe broader economic conditions or seem really good. So maybe unemployment numbers can they look really, really strong, which we'll talk about here in a second. Or if we think maybe that the company stock is undervalued, maybe there's a new product. We're going to go back to Nike as an example. Maybe Nike's got a new product that they're releasing. So people feel really optimistic about those things. All of those things can help move that ask price higher. And people will follow that with the bid price. Economic indicators. So I said we'd kind of touch on this here a little bit. So when we think about the economic indicators that people are going to be looking at that help them identify, hey, is the market in a good position for stock prices to rise? Usually the things that people are going to be looking at are interest rates, what we call GDP or gross domestic product, and unemployment rates. There are other metrics, but these I tell you would be the primary three that people look at when they try to identify what's happening in the economy. If interest rates are going up, that means loans are going to cost more. This will slow down company spending, business growth. It might lower profits. All of those things are probably going to mean that if I'm going back to the last slide, if I'm putting in a bid on a stock and interest rates are going up, I'm going to keep my bid price pretty low, which is probably going to drive down the cost of that stock. Gross domestic product, or GDP, shows how the economy overall is doing. This is talking about what we usually talk about as expansion or contraction. If we see businesses growing, that would mean things like we see they're opening up new plants, they're increasing hiring, they're developing new products. All of those things usually mean that the business is expanding, it's going to earn more, which generally boosts stock prices. Lastly is unemployment. High unemployment usually means fewer people working, spending money. This hurts business performance, generally leads to lower stock prices. So if we're looking for a solid economic indicator, what we would expect would be things like low to flat interest rates. We don't think interest rates are going to move up or down much. A GDP that looks like it's expanding. Usually the target that people have will be in that around 2% as a solid GDP expectation. And then unemployment, usually the number people look at is 5% or less for unemployment. And things start to kind of move around. So like, for example, if we start seeing inflation is going up, well, that will mean that interest rates will probably go up. That's going to impact GDP, just that move alone. And then if all of a sudden unemployment goes, to 5.2%, those are things that would maybe provide indications that our economy is contracting rather than expanding. And it can absolutely impact what we see for stock prices. I know that I just covered a lot. We talked a little bit about just kind of setting the game up, though, so you kind of understand the different things that might be pushing into this. So once we've got that background, let's talk about how we construct something that's meaningful for you and for your goals. So with this, I'm going to kind of switch it to the final four, or my final four for investments. It's going to be diversification, discipline, calculated risk, and time. We're going to start with diversification. So when we think about how we want to create what we call an asset allocation just means I'm going to take my pool of available assets, the money I have to invest, and I'm going to diversify it across things that have different goals. So I can have stocks and bonds, the more aggressive stuff and the more conservative stuff. 91.5% of our performance will be determined by the asset allocation. So this means that if my goal is to be very conservative and I don't want my money to be up and down in the market a whole lot, I might want an allocation that's going to be heavier in bonds. So there's an example here of, if I have 70% of my portfolio in bonds and 30% in stocks, that's a pretty conservative example. If I have a little bit longer time horizon and I'm thinking, yeah, I want to take some risk. I don't want it to go up and down, all over the place a ton. I want to have a little bit of control on this. I might want to have something that looks a little bit more moderate, maybe something that's got 70% in stocks, 30% in bonds. If I'm thinking, you know what, it is first quarter for me, I've got a long investment time horizon. I don't mind taking the risk. I might want to be more aggressive. Maybe I have 90% of my portfolio in stocks and only 10% in bonds. That might be an example of a very aggressive portfolio. What's important to do as you diversify your portfolio is make sure that you have different kinds of things in there, like stocks, bonds, or cash, that have different levels of risk and potential return. So over any one period of time, you might have one asset class that's increasing in value while another might be not doing as well. When you look at asset allocation and diversification, these are approaches that we use to help us mitigate risk. They don't eliminate risk, but they help us really identify how much general risk that we're going to have. One of the things that you always have to look at anytime you pick investments is just making sure that whatever you're selecting, they're suitable for the situation that you're in. And in order to do that, you're going to need to be able to assess risk. This is not a concept I think we've talked about before with this group, and I think it's something that's a really important part to understand, and that's making sure that we understand standard deviation. So our risk tolerance will change with time, and you need to make sure that you understand the risks of the investment that you have, and you need to reassess that. And one of the crucial ways that we use to measure risk is something called standard deviation. It's a metric that we use to help gauge the risk associated with any investment. It quantifies what it really is looking at is the amount of dispersion between the risks and the returns that we have on average. So whatever its average return is, what do we see above and below that? It indicates the volatility of an asset or portfolio just based on those factors alone. It can help us create something that's really a relevant portfolio for us, because as we understand, if something has a higher standard deviation, it's more likely to experience significant price fluctuations. So we're more likely to see that up and down activity in our portfolio. By comparison, if I have something that's got a pretty low standard deviation, I'm not carrying nearly as much risk. So I know that's like throwing around a lot of like metric-y words. I'm going to give you some real examples about how this actually works. So what this means, if we have a standard deviation, the standard deviation return means that 68% of the time, a single standard deviation, 68% of the time, returns are expected to be plus or minus one standard deviation from its average return. And a 2 standard deviation event means 95% of the time, we expect returns to be plus or minus 2 standard deviations. It's not a guarantee or a promise, but it's a way to help us understand the risks. So let's look at like real examples. So let's say I'm in my 401k plan today, and I'm looking at a couple different investments. I look at the money market option that my plan has, and it has a 3% standard deviation, and its mean return, its average return is 2.5%. That means that one standard deviation for that money market means that my range of potential returns is sitting between negative 0.5% and 5.5%. So if I had a 2 standard deviation event, I'd still be looking at a deviation between negative 4.5% and a positive 8.5%. So it's a pretty low standard deviation. That means my risk is pretty controlled. Now let's compare that with, let's say I'm looking at a large cap option within my 401k plan. Maybe I'm looking at something like the S&P 500. And it has a standard deviation of 11%. And the mean, the average return is 7%. That means that one standard deviation, so 68% of the time, I'm going to be expected to return between negative 4 and 18%. So you can see already how much wider that standard deviation is. 2 standard deviations would give me a 95% possibility that my return would be between negative 15% and 29%. So you can see that, the standard deviations really get kind of exponential as they grow outward. I might look at something that has like a small cap. You can see small cap options that have something like an 18% standard deviation. So that means that if I'm in a 1 standard deviation event from that average return, I could be anywhere between negative 9% to positive 27%, 68% of the time. I don't need to understand this perfectly in order to invest. But the idea is that it should help inform my decision about taking risks that are appropriate to me. So for example, we're going to go back to that. Let's say I'm a super conservative investor. I've got 2 years to go before I need that money for a car. Well, if I use those 3 examples, I probably don't want to live in an environment where I have a standard deviation, a single standard deviation of 20%. I probably want something that's going to look a lot more conservative. So I probably want an allocation that's going to have much more of that kind of cash-like or money market type investment, maybe a little bit of that large cap, but maybe none of the small caps. On the flip side of that, maybe I'm getting, again, I've got a long way to go till I retire, and I want to take a little bit more risk. Well, that's fine. Then I probably don't want a lot of that money market because I know that the standard deviation is so narrow. I hope that that's helpful. I feel like this is a concept that we don't talk about a lot because people, I think, get very scared off by the math piece of it. But when you take the math out of it and you just think about it as, hey, this is my potential range of return. How much, if I lived in this kind of a portfolio and my portfolio saw, a negative 18% return, would I be able to handle that? I think those are really what we're trying to get at when we talk about standard deviation and understanding the kind of risk that you have in investment. One of the things I tell you, regardless of if this is in your 401k plan, or maybe you're talking to somebody outside about an investment, as something that you're considering doing, I would never, ever, ever suggest that you invest in anything if you don't understand what your potential losses are, what your potential returns are. So understanding this concept will help you with a number of different things along your investment journey. All right, last couple things that we're going to talk about here is with respect to discipline, making sure that we rebalance. Over time, your asset allocation is going to shift due to the performance of the investments in your allocation. So generally speaking, stocks tend to outperform bonds, which would mean that if I had a starting allocation of, let's say, 40% stocks, 50% bonds, a year later, my allocation might look more like 49% stocks. So making sure that we're disciplined and at least taking a look at our portfolio and rebalancing it back to its target at least once a year is a good practice for us. Lastly, time. The last of our final 4 here. When we invest regularly, the market's going to go up, market's going to go down. Our dollars purchase more or less shares during those periods of time. Dollar cost averaging becomes a really powerful way to mitigate market volatility. If the market's going down, it just means I'm buying more shares when I put my money in. That's not necessarily a bad thing. I'd also point out to you, even in the worst market declines, they've generally been followed by pretty significant recovery. If you think about 2008, 2009, the market rebounded 1 year later by over 50%. So if I was patient during that period of time, I received much, I got whole pretty quickly. Rebounds are very difficult to predict and very difficult to time. So the better way to do this really is to dollar cost average in and be patient with your portfolio. In conclusion, I know we hit a lot, and I know there are some concepts in here we've not talked about before, but I hope that in doing this, it's helped you understand better how the market functions, the principles behind smart investing. Um, there's going to be impacts of things like the crisis in the Middle East right now. It doesn't have to be overwhelming and scary. One of the things that you want to make sure that you're doing is making sure you're investing relative to the amount of risk that you're comfortable taking. Whether you're thinking that's in 1 year, 2 years, 10 years, 20 years, making sure that you're thinking through that. If you have questions at any time and you want to talk about this, I more than encourage you to reach out and ask those questions. We are here to help you. So don't ever feel like you can't reach out to us and ask for a little guidance or help with your own investment scenario. That is everything that I have. If you do have questions, I encourage you to pop them into the chat. But thank you so much for joining today. I'm going to go ahead and stop the recording, but please feel free to ask the questions. I'll be hanging out.